Good morning to all of you. Let me begin my presentation by saying a big thank you to Prime5c for the invitation extended to me to share my thoughts on the future of taxation. It is a pleasure to be here for many reasons, and the foremost being it's an opportunity to connect with the younger generation, which will keep me young. The future of taxation is very important because we see the industries which are operating now in the digital sphere. The operation margins may be thin unless they plan, they structure the organization properly and have tax in mind. Survival itself may become difficult. There are a lot of things happening in the field of taxation, and the next 3 to 4 years will be very challenging for all those people who are in the helm of affairs in the finance. For this presentation of nearly 25 minutes, I would like to segmentize my views on the future of taxation in 3 compartments, 3 segments. One is personal taxation, the second segment being corporate and business income, and the third is international taxation. Although I have listed out in this particular sequence, I would like to take the third one first, international taxation, for the simple reason it is very complex and it has got a very huge impact on the corporate sector. Before I commence my speech on the international taxation, when we have so many people in the front sitting, the young people as well as people who are seasoned in this line of activity, I would like to talk to you something about the blue ocean theory and the red ocean theory. What is this blue ocean theory? When you start your career or when you are in the middle of your career, you get an emerging opportunity, a virgin area where not many people have explored, and you start specializing in that virgin area. The next couple of years, your career itself will be very bright because you will be one of the initial foremost runners in that particular discipline. And what I'm going to talk to you is a blue ocean theory. Red ocean theory is what happens in the existing market. There is competition, huge competition, and you like to be one of the players among this competitive environment. You have to outskill them to survive. The field of international taxation is a blue ocean theory. Something virgin, something new. Not many people have been exposed to it. You got new literature on it. You have to read it. You have to understand it. You have to start implementing it. Supposing a company is having a product here, it's manufacturing and selling it here, it makes a huge profit and it has to pay a huge tax. They'll start another unit in a low tax country and put the distributor there, sell the product, give the product to the distributor, and distributor will sell it to different parts of the globe. Thereby, a part of the profits is parked in an area, in a country where there is no tax or there is minimum tax. This is the trend which is prevailing now. Many people do it. And with the accelerated digitalization and technology development, this type of profit shifting to another destination becomes relatively easy. We have come across situations where a manufacturing of a product is done in one country, the distributor is in another country, the purchaser is in the third country, the payment is made to the fourth country. And all these things are connected digitally, and they get a huge tax benefit out of it. This is the challenge which is facing the world today. This is a huge challenge. Therefore, in October 21, in the month of October 21, the OECD, Organization for Economic Cooperation and Development, they brought out this version, BEPS version 2, base erosion and profit shifting. And they wanted to minimize this. And therefore, they brought in this. Between October 21 and October 23, 2 years' time, all the rules, all the framework have been finalized and released for public debate. 137 countries, including the G20 countries, have signed it and they have agreed to participate in that. Therefore, it is taking up shape. So this is what they have decided, and this is known as the two-pillar strategy, which has been released by the BPS 2 version. And all the guidance they have given in these 2 years. All are detailed literature, which will take a lot of time to read, understand, and digest, and at last implement. Why I say it's a blue ocean theory? Because it may not be applicable to a common professional. But supposing you're working for a large association, large company, multinational enterprise, having operations in different locations in the world, and you happen to be the finance head or the finance chief, then you will have to definitely learn about this and be an expert in this field. The two pillars theory is, first pillar they said, it is applicable to a multinational group which has got a group turnover of 20 billion euros. It's a huge company. And not much progress has been made in pillar 1. So it is in the nascent stage. It's not really developed. Therefore, our focus will not be on pillar 1. We have to apply, and moreover, pillar 1 is very complex and it will take a long time to implement. So today I am going to focus on pillar 2. Pillar 2 is applicable to multinational enterprises having operations in different parts of the globe, where the group turnover exceeds 750 million euros. This is where it is applicable. However, certain entities are excluded. One is the government enterprises, international organizations, national pension, provident fund, investment bankers, and real estate funds. These are all exempted. Not profit organization, these are all exempted. Other entities are subject. As per this pillar 2 concept, what they have said is, why is it people are shifting to a country, some activities to a country, because the tax rate there in that country is less? As per the recommendation of the OECD, which has been agreed by 137 countries, the minimum tax rate in any part of the globe should be 15%. There should not be any country, these 137 countries, should not tax the income which is generated there at a rate less than 15%. So if you are going to pay tax at 15%, then it becomes uneconomical for you to establish an entity there and shift the profit to that country. That is the idea. They have mentioned it. Supposing a particular country is not going to charge a tax at 15%. They're going to charge at a minimum tax as less than 15%. Or there could be a situation where a country does not levy any tax at all. Then the parent company has to pay a top-up tax. Supposing there is a tax in the other country which is only 5%. The difference between the minimum rate, 15%, and the effective tax rate in the country, namely 15 minus 5, 10%, the parent company, and if the parent company happens to be in India, 10% has to be paid by the Indian company. There could be a tax incidence which is imposed on you, which will be very difficult, which you have to factor into your budget proposals. There are two methods by which this top-up tax has to be calculated. I'm not going into the full details, but sufficient if I tell you, one method is known as the inclusive income rate method. That is, as I told you, if the difference, that ultimate parent company has to pay the top-up tax. If there is only one parent company, then this is very simple. But in the framework which they are given and all the guidance they are given over a period of time, there are many situations in the world where there is not a single parent company, but multiple parent companies at different layers. A holds in B, B holds in C, C holds in D, like that. There are multiple layers of parent company. If that is the situation, and the top-up tax is calculated by means of a formula, they are given the formula in the rules. If you work out that top-up tax, and the difference is not paid by the ultimate parent company, then there is a shortfall. That shortfall has to be paid by the unit, the subsidiary company in various units. In other words, wherever you are, you have to pay a minimum 15% tax rate which is coming into force. And what is important and what is interesting is European Union and many countries in the Europe have already signed it. And for the companies, MNEs in European Union, it is applicable from 1st of April 2024. We are in the end of March 24. Few days from now, this will tick off and this will become operational for those countries. Few other countries have said that they will apply it from 1st April 25, next year onwards. So, it's the right time that Prime5c is organizing an event like this and asking us to share our ideas and thoughts on the future of taxation. Because there is something known as global return has to be filed by all these MNEs. At present, I have gone through the database of some of the large companies here. Even large, well-regulated company is not having all the information which is required to submit this return, which you have to submit by the end of March 25. They are not having the information with them. So if they want to, they should start working now. They should develop their infrastructure, the network within the organization, the systems within the organization. Atreya was telling about SAP. This is a point which we have to discuss with SAP. They have to include all these things so that that return could be filed on time. And if there is a delay, what type of consequences they have to provide for is something which we have to study. Why I am saying is, it takes anything between 18 months to 24 months to kickstart the operations of the Pillar 2 in any big multinational enterprise. So when we are narrating this to you, and if you in turn share it with finance heads in various MNEs, then they will start acting on it and they will be ready to implement it. And ultimately, they have to comply with it. And if they don't comply with it, it amounts to serious consequences. So, in brief, I've explained to you Pillar 2, which is very important and which will have a serious impact on the working and finances of large corporates. First of all, you see whether you come within that 750 million euro dollars for the group as a whole, whether you exceed. If you exceed, then start developing the material, required data, then systems, see that the return is filed and comply with it so that you don't land up into any serious consequences. There's one more small element about this pillar 2. And this element is known as, I could call it, subject to tax rules. Those of you who deal with tax may be familiar with it. And I will take another 3 or 4 minutes of your time to explain it with the help of a small example. Now let me first tell you what is this. This is known as subject to tax rules. Please listen to me carefully. There's a company in India. It buys management services from a company in S country, a different country. That company is supplying or providing managerial services to the Indian company here. The Indian company is making payment. And when the Indian company is making payment, as per the Indian tax laws as on date, that professional management fee, as per the Income Tax Act, it is chargeable to tax at 20%. So the Indian company has to pay tax at 20%. Not the Indian company, the foreign company has to pay but 20% tax because they are paying the management fee to a foreign company. However, the double taxation avoidance agreement between India and that country says that the management fee is not chargeable to tax in that country, not chargeable to tax in India, if that foreign company is not having a regular office, a permanent establishment in India. So as per the double taxation avoidance agreement, it is not chargeable to tax in India. So I have clarified one leg of it. India, there is no tax on the foreign company. Is it taxable in that foreign country? The laws of that country says it is chargeable to tax at 17% there. 17%. However, the law of that country says if the amount payable to them, it's not paid in S country, but it is paid in some other country, then it is not chargeable to tax in S country. In the instant case which I am referring to, they have structured the transaction in such a manner that as per the DTA, there is no tax in India. As per the laws in the S country, if the payment is made to another country, it is not chargeable to tax in X country. So they make the payment to another country and it is not chargeable to tax S country. Literally, the management fee which is paid to a company in S country is not chargeable to tax in India, neither in India nor in S country. They don't want this thing to happen. They don't want this thing to happen. This is a global erosion of tax, which is not correct. They want all these companies, they contribute to the government exchequer. So what they have said is, in case there is no tax like this, then Indian company has got the right, has got the power, has got the ability to collect tax at 99%, up to a maximum level of 9% on that management fees they paid to the S company there. In other words, that amount which you pay to S company, as per the DTA, is not chargeable to tax. This will be incorporated in the agreement itself and they will pay tax at 9%. So this type of complex jam. The entire Pillar 2 has got 10 chapters. There's a separate chapter on mergers and acquisitions. There's a separate chapter for dealing with deferred taxation. There's a separate chapter dealing with carry forward of losses. What I have given is a bird's eye picture of the entire Pillar 2, which according to me is very, very important. And all of us have to, ironically, before we started these proceedings, they showed a film of a cyclist going off a rough path and going up to the mountain of the hill. Therefore, if you want to implement this pillar 2, you must be as strong as that human being and as sturdy as the bike which took him to that level. I hope you will gear up to that level, and you will spread this message among various corporates and make them future ready to comply with this important aspect. Having said this, I'll go to the next two things, which will not take much of our time, but I would like to share something. As far as the corporate and business income is concerned, there is a total shift. You expect a paradigm shift to happen. What is it? Under the existing laws, there are tax incentives given for various activities. There's a special deduction given for research activities. There's a special deduction given if you set up an activity in a particular area. There are certain special concessions. Going forward, the future of taxation is that the income tax law, as far as this segment is concerned, will become more simple. All these incentives will be withdrawn from the Income Tax Act. Slowly and gradually, it will be withdrawn. It will be given to the respective departments, rightly so. In my view, it's rightly so. Because people in the helm of affairs in the income tax department, if you ask them what is a research project, they will be very theoretical in their application as far as research project. But if you give that to a research organization, that research organization will be able to dive deep and find out whether the organization is really doing a research activity or not doing a research activity. So the incentives will be given to various departments and not routed through the income tax law. This is, the rates of taxes will come down. Rates of taxes will come down. It has come down, and when I started the practice in 1976, it's a bitter thing I would like to share. The atmosphere here is very pleasant. I'll be disturbing it to a certain extent when I say this. The rate of tax when we started the practice in the year 1976 was as high as 85%. If a person earns more than 1 lakh of rupees, on that 1 rupee in excess of 1 lakh, 85% will go off as income tax. The balance 15% only you can take home. And I used to style in a lighter way, that balance 15% also he has to give to the auditor who consults him, whom he consults for this. So anything above 1 lakh, for him to take home anything will be difficult. From 85%, we have come down to 22%, which is a good thing, which started with Mr. VP Singh in the tax reforms. He reduced the rate of tax and gradually it has come, and it will come down further also. So that is the second thing. Third thing is, which will happen is, all the social activities, like, the CSR activities has already come through the corporate activity. They said all corporate have to spend a minimum percentage of their profits for social responsibilities. Similarly, many other things, social responsibility will be brought into the Income Tax Act. Already they are governing the labor legislation. Those deductions to employee-related benefits will be allowed as deduction only on payment basis. They have very clearly said that. Similarly, now they have included payment to MSMEs. They want to protect the MSMEs. In other words, the income tax law is used as a tool to regulate other regulations. So that will continue as far as this corporate taxation is concerned. So these are the emerging things as far as the corporate tax is concerned. On a personal level, personal taxation, already they have withdrawn all the concessions and they reduced the rate of tax. That trend is likely to continue. But year after year, when the budget is presented, if you read the newspapers and business magazines, 2-3 days or 1 week before the budget is presentation, each one will say in his column that the threshold limit has to be increased from existing 2.5 lakhs to 8 lakhs, 10 lakhs, considering the cost of inflation, the rise in inflation. But take it from me, nothing like that will happen. Whichever government is in, no government will be interested in increasing the threshold limit. The threshold, if at all it is increased from 2.5 lakhs, it may go up to 2.75 lakhs. It cannot be drastically increased. Why it cannot be drastically increased? Because if they increase it to a higher amount, the number of taxpayers will get reduced. And for a developing country, the number of taxpayers cannot reduce, should not reduce. And hence, the number of taxpayers to keep rising. What has happened during the last 3-4 years, the number of people filing returns has gone up. The tax collection is robust. And for many years, I've been telling that the percentage of direct taxes should be more than the percentage of indirect taxes. And that is beginning to happen from the last year onwards. Why is it direct taxes are more important? Because the person who has got the ability to pay has to pay direct taxes. Indirect taxes is levied even on the common person. Right from the toothbrush you use in the morning to whatever you use till you go to bed, all these things are subject to indirect taxes. So even an ordinary person has to take the brunt of indirect taxes, which is not good for a country. So now things are happening in the right direction in the sense the direct taxes collection is going up compared to the indirect taxes. It's a good thing to happen and it will continue. But the threshold, the rates of tax may come down a bit, but the threshold limit will not be increased. All the incentives will be withdrawn. The income tax law will become a much more simpler legislation. This is my expectation. Hopefully, if Prime5c is going to organize a meeting, say after 3-4 years like this, another boot camp like this, they will come and echo what I have told here as being the reality. We expect that to happen. So that is as far as the personal front is concerned. Like to conclude by saying, people like me and some of you here who are born before 1970, we had the experience of seeing so many reforms. We had the tax reform, we got the automobile boom, we have got the, telecom bust, we have got, financial sector reforms, the technology impact, all these things we have seen. But those people who were born after 2000, you have missed all these opportunities. We have gone through this, we have experienced. I know how it was, phones, when we had to rush to a particular landline to attend a call. Today, at a touch of a button, we are able to speak over video to any person, any part of the globe. Both we are experienced, but you don't have the experience of that one. So to that extent, but to offset all these things, my concluding remark is like this. You people are going to see something which people who are born before 70 have not seen. What is that? Because of the technology, because of the, digitalization which is taking place, and which is sophisticated instruments which are coming, business disruptions are going to be more common. And the number of cyber crimes which you are going to face and you're going to address, you're going to solve, will be phenomenal, which we people will not have the experience. You people have to enjoy, cherish, and find solutions for such type of problems. This is, in a cursory way, I could say, future of taxation for all of us. So better opportunities are available for the professionals, not in the regular tax regime, but in the international front. You help a person who is in the SAP to develop a proper system to capture all this information, give the information correctly, and make them ready to, apply Pillar 2, which is going to be the breadwinner for many of the professionals and many of the people working in the industry. I thank Patabi and all those people, Atreya and others in Prime5c for this opportunity, and hope I have concluded within the time which is allotted to me. Thank you very much for the patient listening.